So welcome back, everybody, for another webinar hosted from Princeton for everyone worldwide. We're very happy to have Alberto Cavallo with us. Hi, Alberto.
Hello.
Alberto will talk about COVID inflation, evidence from real-time data, so very up-to-date data and new evidence on that. And before I give the floor to Alberto, I give some few opening remarks. So if you look at the inflations we have experienced since the COVID crisis, what they refer to as inflation whipsaw, essentially when the COVID crisis started, we saw a huge drop in inflations. That's what the inflation expectations of the bond traders are, looking at the TIPS break-even point between treasury inflation protected bonds and regular treasury bonds. And you see it dropped off like a stone, and then it came back and actually overshot the previous line, and overshot the 2% as well. If you look at the household expectations from the Michigan survey, you also saw that it came down a little bit, but then it went up significantly as well. Typically, people expect a higher inflation than what actually realizes, and also much higher what the bond traders expect. But you see a significant increase in their expectations as well. That's for the United States. Alberto will also talk outside of the United States, including emerging economies and other aspects. Now, what are the important inflation scenarios we have to think about? One is, of course, it could be that, we have the price level on the y-axis, and we just have an increase in the price level. That's inflation, the slope of this line. Inflation is popping up, and then it's coming down below what it was before, and it goes back to the old price path. And that's one inflation scenario. Another inflation scenario is that we have an increase, a temporary increase in inflation, so slope increases, and then we go back to the old one. Or we have a permanent increase in inflation. That's essentially here the slope is low, below 2%, as we had previously, and then it goes above 2% permanently, for example. But I think what's really something to look out for is whether we have accelerating inflation. So we have inflation which is, the slope is actually increasing over time. So when we start with a low slope, then it gets steeper and steeper and steeper. And that would be the dangerous scenario to figure out. So we want to look in the data very carefully, and hopefully Alberto can give us a glimpse whether the data is giving some indication whether that's a one-time blip, as this one, and then it actually goes to a lower level back, or it's a one-time blip this way and goes back, or it is a permanent increase of inflation, or even worse, an accelerating inflation phenomenon. And of course, we can look at relative price changes, but relative price change is not really inflation. We would like to know how the whole basket shifts. Of course, within the basket, relative prices can change. And we want relative prices to change because that's a signal of scarcity, going back to Hayek's famous information role of prices. But it might also give us a hint whether we have a permanent change or just some spike, one-time inflation spike. And one argument for the inflation spike is essentially that the COVID inflation we're having now is just undoing the low inflation we had when the shock came. And that's what I took here from San Francisco Fed position paper, where you see that they divide the inflation in some COVID-sensitive basket and a COVID-insensitive basket. And you see the COVID-sensitive basket, the price the inflation came down significantly, so undershot the target, and then now we undo it. So one benign interpretation is that, we had too little inflation, in particular in the COVID-sensitive basket component, and then just now we're correcting that. So if you take this perspective, there's nothing much to worry about. If this is just a one-time spike and it's just for the COVID, we couldn't go to restaurants, restaurant prices are depressed. You can go to, and now restaurant prices are picking up again, but it's just a one-time spike to undo the missing inflation from March 2020. Now, whether this is a one-time temporary spike or permanent, I think that's, in my view, the key question. And if you look back in history, in the 1970s, this was also a key question. And why did we have this high inflation in the 1970s? It was not because Arthur Burns was pushed by the politicians. This might have been true too, but mostly he had a mistaken theory. So his theory was, so the Fed chairman's theory at that time in the 1970s, so Arthur Burns' theory was, if you keep prices and wages under price control, so you don't allow prices to adjust, but then you avoid some wage push effects, so the second round effects would not kick in. And these are the accelerating component comes to the second round effects, and just control initially by law not allowing prices to go up, you can actually kill off, that was the theory, the second round effects. The second round effects, of course, depend very much on inflation expectations. And once people expect inflation will be higher, they'll demand higher wages. Because of higher wages, the product prices will go up and so forth. And there's an interaction. You need underlying theory and you need measurement. And you know, the theory that the expectations are so important, that's essentially one of the outcomes from the 1970s. The other thing is, which is very important, connected to that, is the inflation anchor. How strong is the inflation anchor? Will, you know, temporarily we shoot up, but the anchor is so strong we come back to our 2%. And that depends a little bit how much media attention there is. If everybody's focusing and is getting worried about high inflation, then inflation will be self-fulfilling and will come up. And it depends how easy you can coordinate on price increases. And statements like Warren Buffett, he recently made in his a big investor gathering, that, you know, everybody's increasing prices, and you can see that this might encourage other firms to increase prices too, because there's a coordination. It makes it easier to coordinate a price increase. If it's very difficult to coordinate price increases, then price increases, everybody will be reluctant to be the first mover to increase the prices. And of course, that's a nice setting where higher order beliefs and other beliefs, what the others will do, matter a lot in a world with strategic complementarities. But let me just look at some few data in this regard, and then Alberto will go much more in detail in some fine-tuned data. Here just depict essentially a fraction of firms who plan to raise prices. So they are, and that's, you know, historically, and that's what you see recently. So when the COVID crisis started, they didn't plan at all to increase prices, but now it's more than 40%. And that's much higher what we ever experienced before. Okay, but it could still be because, you know, they didn't increase previously. That's just a correction. So that's a big question. The other thing is, if you look at inventories, is it like the case that, you know, what's the inventory situation? If the inventories are very low, and then I think Alberto can tell us more about this, because he sees probably which products are disappearing from the marketplace, on the online marketplace. But here you see the inventories for retail and wholesale dropped at a record low level. So they're very, very low already. And these inventories, if the inventories are low, firms are more inclined to raise prices, and all this is coming up. Now, let me go to Alberto's poll questions, and that's the questions you tried to answer. The first question was, what is the main advantage of having private sector data for economic statistics? So what Alberto, with the billion price index, has created, he creates essentially billions of data, real-time data from online thing. What's the big advantage? Is it speed? You get it right away. Is it high frequency? You get it all the time, every minute? Or is it detail? Or is it other? And the answers, 18% think it's speed, 39% think it's high frequency. The details, it's 36%, and other aspects only 7%. So most of them people think the high frequency is a big advantage. And then the second one is 36% think it's the details. Second question is, during the COVID crisis, did you personally experience higher than measured inflation, lower inflation, or similar? And 39% say higher than measured, 13% lower than measured, and 48% similar. Okay, so they were happy with the CPI index measurement. The third question was, were you surprised with the rapid increase in US inflation? Yes or no? 24% said yes, but majority, 76% or 3/4 said they were not surprised. Of course, our audience are mostly economists, so perhaps they predicted that. And did you believe that the increase in inflation is mostly temporary? That was a big question I tried to throw at you, and you had an answer already, and 68% think, so more than 2/3 think it's temporary, and only 32% think, roughly a third, think it is a permanent. So there's some dividing line, because such an important question, if a third think it will be permanent, that's also something we do have to figure out, and we hope that Alberto will shed some light on this and many, many other things. And of course, I was focusing very much on the US and Europe, but Alberto will go across the globe and I cover all the emerging economies too. So we're looking forward to his insights. So Alberto, the floor is yours.
Thank you so much, Markus, and thank you everyone for joining this call. It's a pleasure to be here today. I'm going to share my screen and walk you through first the motivation for the talk today. Many of the things Markus mentioned, I'm going to try to address with this discussion on COVID inflation and trying to leverage as much as I can the real-time data to shed some lights on what is going on. And the motivation is easy to explain when you look at the actual current data that we have on inflation. So you're looking here at the US price index during the COVID period. And I'm showing you two versions. One is the CPI, the all item CPI in blue. It looks like a step function because it's a monthly index. And then you have this other index there that I labeled the online index. I'm going to describe clearly very soon how we create this. But what's interesting to try to understand, I think, at this point in time, is what is happening lately. This pattern that you see in the online index since the end of November of a much higher inflation trend. In a way, this looks a lot to that graph Markus was putting for the permanent change in inflation. Although it may be too early to tell, we should try to get a sense, and I'm going to try to give you some sense today of whether we're likely to see this softening up in the future. The CPI shows something very similar, only that it starts a little bit later, but both of these indicators are showing these high levels of inflation. So that's what I'm going to try to do today. Let me share a roadmap first. Since I'm going to use a lot of these online price indices in the talk, I'm going to first describe a little bit what they are so you understand their advantages and disadvantages. And in that context, I'm going to speak a little bit about current inflation trends. I wasn't planning in the end to talk so much about developing countries in the talk, but I'm happy to address that in the questions and answers and show you some data. Mostly then I'll focus on trying to understand what is driving this higher level of inflation. And I'm gonna try to use the real-time data to address three issues or factors that have been mentioned quite a lot in recent months. First, many of you will hear about measurement distortions, and in particular, that base effect that has become so famous. But I'm going to try to first address one that I think is equally important, particularly for the numbers we have seen in the last 2 months, which has to do with these basket weights that Markus was showing us as well in some of his graphs. Then I'm going to try to use the real-time data to see what has been happening with supply disruptions, and in particular, measuring stockouts within retailers and seeing what the impact is that they're having on prices. And finally, I have some preliminary results, very real-time in this case, about potential sales behavior that can be informative, I believe, about some of the pent-up demand dynamics that people have brought up as potentially important. Okay, so that's basically where I'm going. Let me start with a little bit of the history of inflation measurement, so you know where I'm coming from. I'm originally from Argentina. Back in 2007, Argentina started lying about the inflation rate. So I realized that there was a lot of information online, and I decided to use this technique called web scraping. That basically it's a software that goes to the websites of large retailers, looks at the underlying code, and can store that information in a database. This was allowing me to build an alternative source of data. I built a website at the time that ran automatically and showed what the actual daily inflation rate was, and showed prices for individual goods as a way to validate and gain credibility. And later I wrote a paper, probably one of the most fun papers I've ever written, trying to show how is it that the government was lying about the inflation rate and trying to find ways to replicate this. Not that it mattered much, to be honest, because the manipulation of the official statistics in Argentina continued for over 10 years. You're seeing this graph here comparing the online index to the official one, basically until 2016, when there was a new government. That's when we started seeing these two move together. But during a very long time, there was no, no real official metric that we could rely on. But still, it didn't change policy, but it allowed me to realize there was a tremendous amount of potential here. And in particular with Roberto Rigobon, who was my advisor, and gave me a lot of support to expand this to other countries. We created in 2008 the Billion Prices project, which is probably the name that you're mostly familiar with if you've heard about this before. If you're interested in the research we did in those initial years, there was this paper at the Journal of Economic Perspectives summarizing that. We published it in 2016. Now, as we started expanding, it became very clear that there was a need to fund this some other way so that the data collection could continue over time. And that's actually when we created PriceStats, which is a private company, which since 2010 is really the one who's been collecting all this information and producing some of these real-time inflation indices I'm going to show you in a second. PriceStats does it in 22 countries with daily data that is collected online, pretty much in the same way I was doing in Argentina, but a much larger and higher quality way. There are about 1,000 large retailers, over 1,000 now that where data is collected from. PriceStats produces other indicators that are useful, for example, PPP that I may go into, comparing identical prices of goods in one country versus the US. And then obviously this data is shared to the is sold to the financial sector. That's how we finance all the operation, but we share this information freely with central banks, policymakers, national statistical agencies, and researchers. In particular, during COVID, one thing that I'm proud of what PriceStats did is that it started providing data to the statistical agencies that were unable to send people to the stores in the traditional way. So, you know, and for me, I guess I want to emphasize this was particularly important for this to become a research project that we can continue over time. If you stop and you just do it for a while, then it has very limited impact. So that's the main advantage of all these from my perspective. So let me describe some things that you should know about the data when you compare it to the CPI. First is the speed. We can build these indices in real time and release them with only a 3-day lag. So, you know, some of you mentioned this as an important dimension. The high frequency, I actually agree with many of you who responded in the poll that is available on a you know, daily frequency. Even if you cannot see right away, being able to see these patterns and changes in high frequency provides a lot of details on the time series, which are quite useful, particularly to detect those trends that we were describing. There's a low cost of observation, particularly versus traditional survey methods, which allows us to collect the full price history for all goods that are sold in each retailer. And I emphasize this because for the microanalysis that I'm going to show you today with some of the papers, it is very important to detect when a product enters and start following immediately until it disappears, and do it for all the goods that are actually being sold. So from a research perspective, this is very important. You can also have identical methodologies in every country and over time, which facilitates comparison. And we do not have quantities in the data, just as the CPI, but we try to use official basket weights as much as possible and mimic the main CPI methodologies for index construction. So that's about how similar, or if you will, how some advantages that the data has. Now, what are sources of disadvantages or potentially differences with the CPI? First of all, there are no hedonics here, no seasonal adjustments or other special index methods which can create deviations from the CPIs. We just don't have the capacity that a statistical agency has to do these kind of things, and we don't want to be constantly adjusting the indices as well. And there's limited coverage on 2 dimensions. One is the type of retailers that we monitor, what I call multi-channel. They are large, usually offline retailers that also sell online. So you can think of retailers in the world as being completely offline, completely online as Amazon, and then you have this middle section in the middle, which are very traditionally large companies that sell in both locations. That's where my data is coming from. Now, before someone asks if you collect the price online, is it different from the price offline, which I always used to get, let me just point you in that case to this paper I wrote several years ago, where I sent people to the stores with their phones, and we scanned barcodes, check their prices immediately, and we found that on average 70% of the time prices are identical. But for that subset in the middle that I'm describing of these multi-channel retailers, no? And it validates data. Now, the CPI can have a lot of offline retailers. We're never going to be able to capture that information, and that can create some differences.
So,
and fine, yes.
So Philip Hartnum would like to know whether you also include commodity prices like oil or food. Is this also part of your measurement? Or
yeah, so for example, fuel, there are sources, no one sells fuel online, but you can find online sources of fuel information in high frequency, so that gets incorporated. Yeah, the vast majority of these are things that are sold online, but there are some commodities like that are actually available now. And that actually brings me to the next point, which is which are the sectors that we cover. Most goods that are in a CPI basket, we can get them. And I say most because there are a few exceptions. And one that is particularly important right now is used cars and trucks, which has a special index methodology. And we have never collected data for that in the US, in part because it had never been as important as it was last month, but I'm going to refer to that in a second. And there are, a few other goods that are hard to collect online. What's really not there significantly up to this date is everything that has to do with services. It's very hard to collect service information. It's not standardized. It's hard to decide exactly how you can price the same service over time. And there's in particular no housing as well. So this is a significant part of the CPI basket. Usually housing has these very slow moving trends, so it doesn't affect some of the views that you can generate in more high frequency, but it's certainly a limitation when you're comparing some of these two indices to have in mind. And that's why I wanted to emphasize, if you start thinking, what are these indices useful for? They won't be useful to perfectly match the CPI inflation rates you see published by the statistical agencies every month. And I'm showing you that, for example, with the place where this is most obvious, which is Europe. We create individual indices for different countries in Europe, and then we create a Eurozone index using their consumption levels as relative weights. And this is the index that you would get, and you're looking at the monthly inflation rate. Obviously, there are some months where the inflation rate sort of the online index tracks roughly the tendency of the inflation rate, but cannot match these big spikes and drops that happen in the CPI. This, in particular in Europe, is because the European indices tend to do very little adjustment for apparel, so it creates these wild swings in the CPIs that can complicate things. But I bring it as an example of how the index methodology can actually have an impact, and yet still we can correctly sort of track some of the tendencies that you see there. Even in the US, I wanted to clarify this, which is the country where these two indices move more closely together. You will see there are often time periods like these ones in February that I'm highlighting, where things like housing or hotels, which we also do not have being a service, create some of these temporary departures. No? And the one that I was referring to in particular, for those of you who are looking at this right now, you will see a decline here in our index that is not yet matched by the CPI. In part, this is because the CPI had this huge increase in used cars and trucks, which is not in our index. If I were to adjust the CPI a little bit, you would see it come down. Okay, so if it's not useful to match exactly the numbers, what is it useful for? It's really consistently been allowing us to anticipate changes in inflation trends. And I'm showing you a graph from that initial Billion Prices project paper that shows you the US index at the time of Lehman Brothers bankruptcy, when we realized how powerful this was for anticipating these changes. I'm listing, you have the index and the CPI, and you see this date, September 16 of 2008. That's the day Lehman Brothers went bankrupt. In just a couple of, the following day, in fact, we started seeing these retailers massively reducing their prices because they were obviously anticipating a big collapse in the economy. And the CPI took a while to show that effect coming in. And then towards the end of, towards December, before the holidays, we see a change in trend that eventually the CPI matches to. So this is a trend and a type of behavior that we have seen happening over and over again. I'm going back to the graph of COVID, and you can see those same turning points happening before the CPI. You see it here in November, and the CPI a couple of months later starting to show a similar trend. So this is what I think part of the reason why this is useful for those interested in sort of forecasting, even if you will, the numbers of the CPI. There are many of these turning points in the data. I'm just showing you what happened in the Eurozone as well. I could show you similar graphs for all the countries, but it was very clear towards the middle of the year, and in particular at the end of the 2020, that we were on new trajectories in many of these series, and the CPIs are starting to reflect that as well. So
Alberto, can you give us a sense how many days in advance are you ahead of the official measurement? Is it like a month or two, or is it?
Well, it depends on the country. We have estimated this differently for different countries. In the US, it's about 2 to 3 months. And that's sort of clear here. In general, you have to wait a couple of months where you see the change in the CPI. Part of that is a publication lag. So it's the fact that you don't see the information on CPI until a month later. But then even accounting for the publication lag, some sectors seem to adjust about a month or sometimes 2 months before. Reasons for that we have explored in our research have to do with the fact that even though online and offline prices are similar most of the time, sometimes when there's a shock, some of these retailers may adjust their prices sooner online than they do offline. That gives us some anticipation. And also we are looking at a sample of large retailers, which also tend to adjust sometimes faster to the shock. So this can introduce some anticipation into this series.
So can I ask you,
yes.
So the official statistics probably uses more and more online data as well. Now, how big is the online component of the official statistics compared? I mean, you have 100% online, and they might also have 20, 30% online.
Right. So I actually have a graph for that later on, but let me give you the short answer. Normally, it was less than 20% in the US that was being collected online. And usually it was things like, I believe, airline tickets and things like that are actually easier to search online, even if you're doing it manually. And when COVID hit, 80% of items started being collected online. That continues to be the case today, and it's even greater for if you focus on goods. No? So in a way, what has happened is that the current sample of the BLS and other statistical agencies is using some of these methodologies. It happened very quickly, so they had to make a very quick adjustment. But I want to point out, I think there's been a transformation, and it's remarkable how quickly they were able to adjust and start collecting data through.
So is your advantage then going away, in a sense, if the BLS is doing everything?
That may be the case. I don't know if they're going to go back. Hopefully not, but that may well be the case in some sectors. But still, I'm going to argue this is not the greatest advantage of this, and that's where I'm going. I'm going to tell you this is useful for people who are trying, to forecast the very short run. If you look more long run, if you ask questions about, that probably most economists are interested in, is how long this will last, how much temporary or not this will be. That's when you really need to go deeper into the details, and the high frequency and the ability to access the micro data becomes particularly important. So I'm going to try to emphasize that now, okay? But first, let me tell you, if you look at all the countries that we collect data from, and what I'm showing you here is the annual inflation rate, and I'm showing you the range of the last 13 years since we've been collecting data. You see the average levels here, and then the level that we are currently in. You're going to see that nearly every country here is at the top of the range. We have the highest inflation level. I've only left Argentina out because it completely, complicates the scale of this graph because of the high level. But there are just a few exceptions: Uruguay, Russia, and China. In China, we can see only a subset of goods, but supermarket and fresh foods are having a low inflation. But everyone else is experiencing a similar trend and have the similar type of turning points. So as I was saying, I think the biggest advantage of having this real-time data is looking at the details and trying to figure out what is really driving this. And I'm going to do that in the context of the US. The US has been attracting a lot of attention lately. You can see our index seems to be peaking at 4%. The CPI is going above that, but I suspect this will start peaking again relatively soon. And what I'm going to try to do now is understand what is really the force behind this, so we get a better sense of why, where we may end up. And some of you are aware there are three main factors that are frequently mentioned to describe what is happening by the Fed, by the White House, and others. And many economists have pointed this out. Measurement distortions first, in particular base effects. And I'm going to talk about basket effects. there's been the supply disruptions and the pent-up demand. So what I'm going to try to do now is ask and show you that we can sometimes use real-time data to estimate and sort of quantify how important they really are in some of these trends. So let me start with the measurement distortions. There are some distortions that happen at the beginning that have to do with the inability to collect data, but as we were saying, the switch was done quite quickly and appears to have gone well. There was one that became, there were papers, for example, like Erwin Dewert with Kevin Fox brought this up right away from a theoretical perspective. They pointed out that the suddenness of the shock during COVID was shifting around the importance of different sectors in the CPI basket, and that the basket of the CPI was not designed to adjust for that. In fact, the US weights in the CPI are adjusted only once a year in December, and usually with 2 years of lagged data. So right now in December, for example, it was updated with data collected in 2017 and 18. And that's perfectly fine in normal times. They don't really move that around that much. But then when you get hit by a shock like COVID, it dramatically changes some of these consumption patterns. And in particular, it made all of us consume a lot more food and a lot less transportation. So I'm going to use a real-time data source here, but let me be clear, I won't use the online prices for now because I want to make a point. This is about these consumption weights and getting information in real time that I think is so useful. So the data source is one that I'm sure many of you are aware, and Raj Chetty, John Friedman, and others from the group of Opportunity Insights already presented here. They had this fascinating project where they convinced private companies to share information, in particular, one that has information on credit and debit cards data, was willing to provide information on how much people are spending in different categories of goods. And you can see these patterns relative to pre-pandemic levels, big collapse in April in everything except for food, and then a gradual recovery. I want to point out two things that are important for the discussion on the basket of the CPI. One is that food becomes more important and remains so even today. And then the second one is there is a recovery, but it's mostly on apparel and general merchandise or healthcare, and very little recovery. Even today, if you look at the latest numbers, we're still 25% below in transportation, which becomes very important because when you readjust the weights of these baskets, as I did in this paper, this weight of transportation and food have a big impact because they are the sectors that have these more volatile movements on a month-to-month basis. So what was happening at the beginning of the pandemic? All along, the CPI has had too much weight on transportation and too little weight on food, but there were differences in the behavior of these sectoral indices. At the beginning of the pandemic, food was going up and transportation was falling, and it was pushing the CPI down. But if you adjusted the basket with these new weights, you would get an index like this, which is what I had in the paper that the last version that I put out in December. Basically, it was saying that the CPI was underestimating the annual inflation rate because it was not taking into account that we were all in lockdown and consuming more food that was going up, and really gas prices were coming down, but we were not able to go up. Now, the interesting thing is, you would think this is a temporary thing, not particularly a first order effect, but it can have an impact on the interpretation of some of these monthly numbers that get thrown at us. And I'm gonna in particular emphasize that if you move forward to 2021 and start looking at what has been happening in the last few months, actually the directional bias reversed, and we're now overestimating the annual inflation rate. Why is this the case? I mean, if you adjust the basket, you get an annual inflation rate of 4.2, which is significantly below the 5.1 that we've all heard in the headline CPI. Why is this happening? Well, still the CPI is putting too much weight on transportation, even though we're still 25% below pre-COVID levels according to Opportunity Insights. And second, in particular, by the way, let me say that's used cars and trucks in April. But since the beginning of the year, fuel prices have been going up, and I think they're being overweight. And then second, there's actually a very direct connection to this topic that everybody's talking about, which is the base effects, no? And this idea that we are comparing prices today. Here, you're looking at the price index. And you know, when you calculate an annual rate, you compare the price level today to a price level exactly 12 months ago, no? And if you do that with the current weighting of the CPI, that's how you get the 5.1 that everyone is emphasizing is a temporary thing. Now, if we had adjusted the basket, the index wouldn't have fallen that much. It would have been more stable all along, so the base effects wouldn't have been that dramatic. And I don't know if we would be having this conversation and people panicking so much if that had been the case. So I'm, I think this is clearly obviously a temporary effect, but it's creating a lot of volatility in some of these series and affecting the discussion. So I wanted to bring it up. There are other results in the paper. It's also affecting core, if you're interested. Because there are some non-energy transportation sectors here that are important. It's creating some inflation inequality because low-income households traditionally consume more food and less transportation. I've shown results in other countries as well where there's a divergence in sectoral inflation rates. And there's a great paper by Marshall Reindorf from the IMF expanding this to many countries. But as I said, it's a temporary thing. Because the consumption patterns are normalizing, it shouldn't affect us more than the next couple of months, I believe. So you can see that here in the latest data I just got a few minutes ago from Opportunity Insights. So the other thing, though, I want to yes.
Your index, you adjusted the basket weights or not?
The online one, no. So this critique I'm making is also applies to this price stats index that I was telling you, because we try to use the official weights as much as possible. So that's why I was saying this is not about the online data doing this correction, but it highlights how we can use some of these real-time indicators that have become available right now to build. And let me be clear, I don't think we should replace the CPI weighting methodology, but clearly having an index that can adjust faster to these shocks during times like this is quite important, I believe. And it is distorting some of the numbers that we're interpreting. So I wanted to bring that up. But as I say here, this is clearly not just about temporary measurement problems. If you go back to the index I was showing at the beginning, and now you calculate this trend that we are on, and this point relative to exactly 6 months ago is an increase of 2.5. So this is about a 5% annualized rate. And this is worrisome. So what I'm going to try to do now is go to the second topic, which is supply disruptions, and see if it can help, if I can detect them in the retail data and see if they've been impacting these prices. Just to reiterate this, in fact, if you focus on the level of inflation that we are detecting online relative to the history that we are normally seeing for each month in the last year or so, you will see that the last 8 of the last 9 months, we've actually had above average inflation, even with an index that doesn't include used cars and trucks. So this is worrisome. What I try to do next is ask whether supply disruptions are really contributing to these increases in prices that we're seeing. This is joint work with Olesi Christoph from the Bank of Canada, and the disclaimer applies that it does not reflect the view of the bank. Now, what are we trying to do? There are these COVID disruptions that we've all heard about, the operational shutdowns, hoarding, change in distribution channels, the cost of operating with social distancing, and all these supply chain bottlenecks. What we try to do is, can we detect them at the retail level, and can we estimate the impact on prices? And the way we're going to do that is we're actually going to try to measure that which we've all experienced, which is the stockouts. When we try to buy things, nothing was available. Still today, many things are not available. So we try to measure stockouts in 17 large retailers in the US. They are selling about 700,000 goods in 5 major categories listed here. They are typical retailers in the sense that if you look at the duration of price changes or absolute size of price changes, they are sort of representative. But these are the ones that show a piece of information which is critical to the way we're measuring this. So imagine you go online to a website. I'm sure many of you have experienced this. You see these signs that say this product is currently unavailable. What we can do is track this over time and simply estimate the share of items that are not available in these retailers. And I can build an index like the one I'm showing you here, using the same weights of the CPI basket for this particular subset of goods. And you can see we started from a level of about 12% before the pandemic. that extends back to 2019. If I were to show you that data, then it had this big spike in April to over 22, 23%, and then a gradual decline over time. Now, by this metric, towards the end of the year, we were back to normal, and things were normal again. And I'm sure if you go to some of stores today or browse online, you're not going to find many goods that are explicitly out of stock. But what has been happening is, in fact, that many of these items started to disappear. It happened at the beginning of the pandemic, gradually seemed to accelerate for a while. So what we can do is essentially look at the total number of products. I'm normalizing them here to 100 at the pre-pandemic level. And you can see that it had a big drop during April, May, and June of last year in the US. And since then, it's going up and down. But today, we're about 20% below pre-COVID levels. So this is a drop in varieties that are available for us to buy. And I interpreted in the paper, we're using this essentially as a measure on how much how many problems, how much trouble there is for some of these retailers to bring these goods back to market as an indirect way to capture those supply disruptions. And this is flipping it around and putting it all together. You can see the levels of stockouts went from about 10% to nearly 40% at the worst time, and we've been oscillating, but we're still around 20% higher than pre-COVID levels. So this looks like bad news, but let me emphasize, the stockouts have already fallen in some sectors. So you look at healthcare or even furnishing and households, after experiencing huge spikes towards the end of the year, some of these sectors started showing some improvements. And this is both the temporary and permanent ones. So this is a relatively good sign, but they are particularly persistent in food and electronics. So if you look, for example, at food, we went from around 20%, nearly 80% of varieties had disappeared, and then we're back around 40. So it's twice as high as it was before. Looking at the details, you would see that it's mostly processed food or anything that has a supply chain that it appears to be more complex. That's where we're seeing some of these issues. And then obviously in electronics, which we've all heard all these issues with chips and other things, that's where it's happening. So I'm going to skip the details of this in the interest of time. I'm happy to come back later on. The important thing here is it affecting inflation or not? And you can show this in several ways. So here I'm simply giving you a simple scatter plot where I've connected the dots sequentially, and you can see both the inflation rate and the fraction out of stock in these more aggregate sectors like the US food and beverages. And you see towards the beginning of March, we had this big spike in the level out of stock that is followed by higher levels of inflation, and then they both move down. But this is a bit of an exception, and obviously to aggregate for us to see anything. If we start going into the more detailed data, looking at specific sectors, I'm plotting here the levels of annual inflation rate with the levels of both temporary and permanent stockouts, and there's this mild correlation between both of them. If you don't control for anything else, you don't get much at this level. But what I'm showing you here is a table where we've actually gone.
Alberto,
yes. Yes.
This is data for many years, or how many years is that? Or?
This is data during this time period, because we have the stockouts data starting in November of 2019. It wasn't being collected before, or wasn't being cleaned before. So it's not a very long time series. And obviously the time period of this shock is quite particular, no? So it's hard, at least in this format, to extract some powerful insights. So what we try to do is first go to the most disaggregated data of sectors we can get, calculate there the out of stocks and the level of annual inflation, and then control for things like the average level of inflation in that sector that we've been seeing. So we put the sector fixed effects. We also include time fixed effects to capture some seasonal patterns that you see in this data. And this is the results I get. So I'm going to try to emphasize a few things here. First, if you look at different sectors, most of the price impact is happening on electronics and some of it in food. So this sort of makes sense. This is where the stocks I was showing you before, the stockouts, are actually more persistent. And that's where we're seeing some of these effects happening stronger now. And then if you just take all goods and you look at this number here, just to be clear, I'm not taking logs or anything in this regression. So these are actual levels. So 1 percentage point increase in the level out of stock leads to a certain percentage point increase in the annual inflation rate. If you take this literally and do some back of the envelope calculation here, for the 20% increase in out of stock that seems to be there and quite persistent for all these goods, that would lead to about a 0.46% increase in the annual inflation rate for these goods. And as I'm mentioning here, in electronics, that's mostly where you would get it. Now, is that a lot or not? Maybe the next question. So I want to emphasize that for some of these sectors, that increase is actually a lot. So the way I'm illustrating that is I'm plotting here the annual inflation rate that we normally see every month for the sector of electronics. You see the average there is actually quite stable. There's some variability. Since April of last year, we've seen about 1% excess annual inflation, let's say, in this series than what we would normally see. So if you take that as a metric, that's about half of that can be explained by this increase that electronics has faced, which in the case of electronics is actually even higher. It's 30% that still remains there. So there is a sense there is a significant impact for these goods. Now, let me be clear. They're obviously in the CPI. There are other sectors experiencing probably something similar to this that I'm not able to observe, like used cars and trucks. But this is certainly, if some of the behaviors we're capturing with this data are also present there and the retailers behave in similar ways, then you can expect some of the supply disruptions to be quite important for us to understand the reasons for this higher trend.
So let me ask you, this could be purely because of can it be part of the chip aspect, or is the chip would not capture all of electronics, or is it mostly because of shipping, the container ships essentially not being able to come from Asia to the US?
I think there are several things
in other areas as well, in Europe and in Asia, where the shipping would be different.
Yes, that would be the next step for us. Start looking at, we only have this clean the data well for the US, but our intention is to be able to compare across countries. Let me just say I skipped the table that provided more details, but we can look at some specific categories. If you look, this column is telling you the current level of out of stock that some of the sectors are experiencing, the last one. And you can see things like information processing equipment, that's where a lot of these stockouts come. So certainly the story that the chip is affecting, some of these computers and other stuff is a driver. But in many of them, shipping costs might also be an important driver of some of these.
But is it clear that it's a supply shock and not a demand shock? Because now we all stay at home. We had to, beef up our home office with new computers and wanted the biggest TV and all that. It might be.
So that's an excellent question. To be frank, I'm measuring a shortage, and that could come because of an excess of demand or a restriction on the supply side. We're linking it to the story of supply because of, there's some, if you plot this index that we created next to a survey of supply disruptions that the census has been conducting with small businesses that I don't have here to show you, but it actually moves roughly in the same way. And the overall story has been one about supply. But you're absolutely right. There are some sectors here that actually experience also shortages because of an increase in demand. And in principle, we care about that to the extent that we can say something about the persistence of each one of those shocks independently. From the purposes of measuring this disruption, let me call it that way, is certainly contributing a lot to some of these. And then the question becomes...
Blanchard, I would like to know something too. It's like, is it the case that you don't have any sales price anymore? Some special discounts went down,
yes,
and not the baseline price is not moving so much.
Yes, actually, I have that in the slides in a few slides. Okay. So let me get to that in a second. Now, that impact that I was showing you was sort of comparing the annual inflation to the level and accumulating a lot of effects over time. What I'm showing you here is we can estimate an impulse response by looking at a shock to this out of stock series and seeing how it affects the monthly inflation rate. And the other thing that comes out from this data is that the effect is gradual and tends to peak at about 6 weeks. So there's this delay in us seeing actually some of these price effects. So The one thing I forgot to mention from the last question is in the paper, we actually have a third section where we use a model to try to put some structure into this. And it's a firm that has to decide the optimal inventory level versus the optimal price to avoid some of the stockouts. And there we try to estimate whether this is truly an replacement cost or not. We ended up getting similar results. So that's the reason why we are sort of emphasizing the supply side story, but certainly a demand side story could also have an impact here. So looking ahead, I wanted to mention, so we worried about this. You have arguments for no. First, the stockouts are falling in many sectors, consistent with the idea that they're temporary. Then the fact that the price impact is limited to sectors where the disruption was more persistent, I think is also a good sign. It suggests, and it's consistent to a paper I wrote last year with Gita, Gopinath, Brent Nyman, and Jenny Tang, where we looked at the trade war, and we actually find slow pass-through because the retailers were constantly telling us, you know, this is temporary, we think this will be resolved, and they were finding other ways to adjust. So it may well be the case that some sectors, particularly those that are back to normal, did experience some of these, but the retailers decided to absorb it with lower markups temporarily. So we may not see much of an impact coming from those as well. On the other hand, I can, this is the way I think about it, so I'm going to bring up my research here. I think there are reasons to be worried, and you know, you mentioned, Markus, what happens with inflation expectations. Certainly, there are some price effects that remain high during the rest of the year that could potentially contribute. And there's a growing literature in which I've been part that tries to see what really affects consumer inflation expectations, and you get that it's their actual experience that people have with goods they can identify and buy often that really drives them. My sense is this movement should be more gradual, and it will obviously depend on what happens with the reaction of the Fed and many other things, but it's certainly something that worries some people. And then the other one, which is particular about COVID, is COVID not only created the supply disruptions, but it just moved a lot of transactions online. And online, prices tend to react faster to shocks. Now, let me be clear. If you go to a large multi-channel retailers, the frequency online and offline is the same. But if you go to an offline, to an online data source, then you actually get more frequent price changes. And that could lead us to have very volatile and quick pass-through of some of these cost shocks, particularly in the CPI data. So I think this is still something to be explored. I'm more on the camp that we should not worry, because there's some sense that is coming from the data that there's this temporary reversion back to normal that I think is.
But do you see online also a lot more reversals? In a sense, it's not persistent, so it's just, you could smooth it out through storage. Do you see that online much more than offline stores? So
I actually cannot make a comparison myself. Because what happens is I only have data from these large multi-channel retailers. But I'll tell you, other papers have looked at, you know, the frequency offline only with the CPI data, and it's, you know, much lower. Yuri Goronchenko and others have looked at online only retailers, and it's higher. What I found is that over the last 10 years, and that's what I did in this paper, these companies that are selling both locations have had to compete more with online only retailers, and you know, with the Amazons of the world. And those are the ones who are using pricing algorithms potentially and are monitoring each other more closely. And that generates a lot of noise, potentially just volatility and noise. You know, they come up very quickly and they come down a lot. But it's not, I think it's still something we need to do a lot of research on to understand really how this might affect.
So let me ask another question about the experienced inflation then impacting the inflation expectations. So we know for regular goods in the US, it's primarily milk and gasoline. In Germany, it's mostly chocolate prices, you know, which drive your experience inflations. Is it online totally different? Are there different goods? Are the electronics more important to make you change your mind what the inflation is and what the inflation will be, your expectations? Okay. So is there any way to see what are the key goods to
which people react? No, what we did in this paper is try to test if we gave people information on individual goods prices, whether we would have more impact, for example, than official statistics. And you do get that, no? Then we tried to see if people were mostly affected by the actual things they bought. So we stopped people outside the supermarket. We scanned their barcodes of the, you know, the tickets, and I could link it to the online data and know the history of inflation of each good. It turns out people had no idea really what they had paid 12 months ago. They were tremendously confused about the actual prices. But the prices that they seemed to be more confident about recalling were the ones that were affecting their inflation rate. I cannot tell you, we never did the analysis of specific which goods are, but others have done that. Michael Weber at Chicago has these great papers exploring this even further. And I think you're right. Part of the reason I wrote the COVID basket paper was to try to emphasize that many people were actually experiencing higher inflation, no? And that can affect this discussion about the anchoring. So let me go to the sales, which is the other thing someone asked me. I am linking it more to demand here, but the story could also be coming from supply. No? But this is, by the way, very preliminary work that I did last week. So it's truly real time, let me put it that way. But you'll get a sense of how this could be used. So, you know, some recent papers in the macro literature have shown that sales, but some kind of sales at least, tend to be counter-cyclical. And I'm citing here Oleski's, Christoph, and Vincent, a recent paper on the cyclicality of sales. Now, if this is the case, then can we look at sales behavior across sectors to say something about what's going on in current demand dynamics? So we can use this data that I have to measure the share of sales and discounts every day using either a sales flag that the retailers have or a price drop algorithm. I'm going to show you some results that are interesting across a few sectors for which we already have the data. So take clothing, for example. When you look at what happened to clothing in the last 4 years in the US, there are some patterns that are striking. First, sales are very seasonal, which is to be expected. You get them high in January and high in June. No? But there was this period immediately after the pandemic started where we see sales go up a lot. And this is probably because the retailers were not selling much. They had these huge inventories. They had this counter-cyclical effect of sales increasing dramatically during this time. But then towards the middle of the year, things went back to normal. And if you look at the current line, which is the green one here, that's why I labeled it back to normal. Apparel doesn't seem to be a sector that is experiencing, at least from this metric, some kind of abnormally high levels of demand. The story is different, though, if you look at furniture. For example, in furniture, the green line, which is 2021, we're seeing really low levels of sales. And I'm linking it here to potentially high demand that this sector is increasing. Someone who just asked said, well, maybe this is because of, you know, the supply shock is preventing them from actually deciding to lower prices. It's an inverse way. Instead of raising prices, you can reduce sales. But it's certainly sort of consistent with the story. It is still not going back to normal. So furniture seems to be one of those places where we're still seeing an excessive demand. Then if you go, for example, to electronics, the story is actually somewhere in between. We get through much of 2021 this very low level of sales compared to the past, and lately we're seeing it go back to normal. So I'm showing you this to illustrate in a way how potentially some of this data can be used, but also to give a sense that there's also arising from this data preliminary some sense that at least these sectors appear to be going back to normal pricing behaviors. So I realize I'm running out of time, but I'm happy to take questions, of course. Let me summarize some of the points I've made today. There's this trend of inflation, which is, it looks for now temporary, but is worrisome in that sense. But there's a lot of evidence that temporary things are affecting the interpretation of those numbers. I've emphasized measurement distortions on the consumption side. I think they're adding actually 0.9% to the annual inflation rate in the latest estimate, because we are putting too much weight on transportation relative to what people are actually experiencing. But perhaps more importantly, I found that we can measure supply disruptions with this data, and we found significant pressure on inflation for this subset of goods. The stockouts are still high, but the price impact is concentrated in those sectors where the disruptions have been more persistent, and many of them are actually going back to normal. So that's a relatively good sign. I mean, I've shown you some preliminary evidence potentially linked to pent-up demand, that sale behavior is unusually high in sectors like furniture, but normalizing in others. So if you ask me how concerned are you, or is this temporary, permanent, I want to acknowledge this trend is worrisome, and I have not seen it yet stabilize or turn in the online data significantly. So we could still be on that new permanent path. But in a way, what my research is showing is that much of this has actually to do to the supply disruptions and things that we can expect to be more temporary. So, and in fact, I don't think that's been true just in this period. It's been all along happening and affecting some of these inflation statistics. So I know you like, Markus, to end with a positive note. Let me just say here that so it looks worrisome. There's some evidence of temporary effects. I think the good news, though, is that we do have a lot more data in this crisis than what we had before to really try to flesh out some of these things. And I'm not just talking about my data. You know, I emphasize opportunity insights. There are banks like BBVA that is producing some consumer spending statistics that are fantastic, and national statistical agencies are transforming themselves. So I think that's, from an economic statistics perspective, great news.
Great, thanks a lot, Alberto. We have a bunch of questions I would like to throw at you. The first one, I would like, you know, we always distinguish between core inflation and non-core inflation based on predictability, because non-core, there's more mean reversion. If you look at the online data, do you also have something in terms of predictability, saying, oh, let me look at only the subset of this online data because they're better in predicting than other data? Is it the same as like excluding energy and food, what we do with core and non-core, or how do you slice the data in this dimension if you want to purely improve predictability?
That's a good point. You know, some people have been saying maybe, you know, after what we've seen with used cars and trucks, maybe we should create a new core that doesn't include that sector because it's, you know, sort of reverting. It's true. I have never thought it that way, that what we're doing and the fact that we focus on these goods that seem to have predictability could be considered as a way of doing that. I'll tell you what I think could be the best way to do this, which is, you know, when we build a core, we say, I want to get away from those sectors like energy and fuel that adjust prices too quickly and they can be very temporary things. But since we don't really have a lot of detail in the data and we cannot observe very detailed statistics, we tend up to exclude whole sectors like, you know, energy, food. And then if you think about it, there are some sectors here, maybe within durables, that have some goods that are very flexible and some goods that are stickier. So one of my goals, as I have been hoping to do, and I never get the time, is to actually build a flexible price index and a sticky price index that looks at all the sectors of the economy and distinguishes within sector the goods that are flexible and sticky, and then uses, you know, you have really a comparable set of indicators. That's potentially what can be done with this data, but that's it's coming in the future. I don't have anything to say.
So the key essentially is to look for these turning points. That's essentially what you say, and you didn't see a turning point yet. To what extent is the dispersion of price increases helping you to identify turning points? So my thinking is, if there's a lot of dispersion of price increases, there's less of an anchor, because, you know, then it actually might make it easier to increase prices, or, you know, if there's an anchor that nobody will increase prices, and I would be concerned to increase my prices compared to my competitor.
Right.
Is the dispersion a good helper to?
Yeah, so we produce what's called a diffusion index that tries to look at this. We do it at the country level. We never actually exploited it much within countries, but I think that goes to your idea. The idea is to see how many of these sectors are actually behaving this way. No? There is research using this data. For example, there's a recent paper on what's called the pricing avalanches that I saw that's a great application and tries to get to this, that when you change one price, then it creates, you know, the incentives for everybody to do this. But it's not work that I've done. Potentially it could work, and absolutely. If anyone who's listening is interested in doing this kind of work, please let me know.
So Joseph Baumgartner asks, you know, compared to the euro area, and I don't know whether that's true, that the weights for 2021 are based on the 2020 consumption basket patterns. So you have to interpret then the euro CPI very differently, because then it's actually underestimating the real inflation.
Right. Yeah, I've seen some analysis doing that because the euro area actually changed the indices. No, I haven't replicated those results, but what's important to remember here is that there are two factors that are changing. One is the weights of the basket, that may be adjusted or not. And the other one is this behavior of the sectoral inflation rates. No, so even if you apply the same weights in changes and you move them a lot in other countries, but the sectoral rates do not change, then you're gonna get different results. No? So I'm sure there's gonna be some work and potentially some distortions, but I haven't done it for Europe.
Then there are some questions concerning emerging market economies, in particular Pakistan and other countries. Perhaps you can allude to it. I mean, you started out with Argentina and the honesty of a price index. Of course, if you change the weights constantly, then it's also the honesty goes away too. It has to be very transparent in a sense, right, to maintain the trust in the price index. So how good is the online price index, like in a country like Pakistan, where there's not so much online going on? There's still a large part of the economy is done in physically, not online. And on the other hand, on top of it, there's the service sector, right, is still very prominent as well.
Right. So that's a big limitation. In fact, we've never been able to produce an index in Pakistan because there's simply little information online. But even in countries where we can get data, for example, in India, we've been trying to build an index there, and you get this, there's a lot of information online, but the online sector seems to behave quite different from what you would get, in a typical offline market, which is where the data is collected. So that's a big limitation, at least at the current stage of things. No, maybe COVID has accelerated the move online and will make some of these markets more integrated. Usually the problem we have is a country where that is kind of in between. And if you go to a country where the online sector is not too well developed, what ends up happening is that the retailers simply put their offline prices on the website, and they want to show that they are cutting edge, so they have this website. But really what you're getting through the website are the prices of the database that is offline. And on the other extreme, you get the US, where the two markets are very integrated. It's usually countries in the middle that have a developing online sector where the differences could last. But that's a temporary limitation. I think we're all moving online a lot more, and hopefully in a few years, this will be possible for many countries.
And then, so Luis Zenz would like to know, can you say a little bit about the geographic dispersion, perhaps within the US, but also across countries? During the COVID crisis, is it the same all over the place, or is it critically different in the Midwest and in the coastal regions? Do you find any differences there?
That's a great question. So I don't collect a lot of data, geographical data in real time. That paper I was mentioning, the one about the Amazon effect, there I actually showed that prices online change more frequently, and that also places that sell online or retailers that sell online actually tend to have uniform prices across all locations. Because think about it, 30 years ago, maybe Walmart could have a different price in Boston and in San Francisco. Nobody could tell. Today, it's very obvious, no? So they have to deal with this. And that actually introduces a lot of uniformity. Whether the uniformity has increased during COVID, I have not tested. But as we have moved online, it is probably the case that we are getting data from or buying from retailers that actually tend to have more uniform prices. So that's possibly happening.
And then there's a lot of questions. I can't handle all of them, but Robert Owen asked about the heterogeneity, the dynamics, and all that. But I would like to enrich that in a sense. If you take your data and match it with some credit card data, like JP Morgan Institute data, and with scanner data, is there some work to match these things, or is it the outcomes are similar across using these various different data sets, or what is the strength of one and what is the weakness of the other one, and taking all the heterogeneity into account?
That's a great question. So in that Billion Prices Project paper, one of the first tables was actually comparing the three main data sources of prices: scanner, CPI, and online. Scanner has the advantage that it has all these quantities. So if you could think of us being able to get some quantity information in real time, it's certainly a great complement to some of these. The problem with scanner data is just one sector, like groceries, and that's it. No, I see more future in the type of data that Opportunity Insights is putting out, and the ability for us to see these spending patterns. No, but that's prices times quantities as well. No, but I think one of the, if you want another positive note, is the ability we now have to merge some of these databases. It's not trivial. You know, the scanner data, I've tried many times to link it to my data, and if you don't have the same identifiers, that becomes quite complicated. But it is becoming more open and easier to do. So that's a good sign.
And is there an effort among researchers to standardize things in order to make it easier to link? Do you work together with Opportunity Insights, with Raj Chetty and his team?
Yeah,
to combine
so
US, or
we've collaborated. I mean, they were really good at sharing with me this data right away. Now, in our case, in these two data sets, it's actually pretty trivial to connect the categories to the ones that I have. So that's not a complication. It's more complicated when you think about getting more detailed micro data on products from scanner data and linking it to the online data. Not because it's technologically difficult so much, but because usually some of the owners of that data are worried about, you know, for example, scanner data, you cannot actually get you know, the names of the products and things like that. So that complicates. No, but there's an openness on many dimensions. So I am optimistic that many of these holders of data will make it more openly available.
But there's no a conference where the BLS guys and you know, Opportunity
So there is an active community among national statistical agencies in experimenting with some of these data sources, and that gets shared. So it was a lot of more research oriented at the beginning. I think now they're actually trying to bring this into production. So we've seen, I think we're going to see a boom in some of these.
And the IMF also has some statistical
capabilities
harmonized across the globe, I guess.
Absolutely, I could do that. One thing I haven't talked about, I mentioned briefly the PPP indices, for example. With our data, we are able to do something similar to what the World Bank does with the famous PPP project, which is one of the largest statistical efforts, you know, to ask statistical agencies to collect and price identical goods across countries. You can do that with online data as well. So I've been collaborating with the people at World Bank and researchers to try to see how online data could actually facilitate efforts like that. And that sort of collaboration has been happening quite productively.
And you see that the real exchange and PPP is converging faster on the online side, because I can always order and buy some products from abroad and ship it over, I guess.
That's correct. So let me share my screen for a second. So you see this. Here we go. These PPPs that we create from this data are, let me explain what these graphs are showing you. I hope you can see them. They're a little bit low. Let's see if I can zoom in. This is a real exchange rate that is constructed by using thousands of identically matched goods in food, electronics, and fuel. So think of it as building a lot of Big Mac indices for all kinds of goods and calculating then an average a real exchange rate. And you can see, for example, here we're looking at the numbers of Brazil. Normally in Brazil, we see a cost of the basket that is about 20% more expensive. At least that was the case in 2018. And then it has been falling over time in this data. No? Now, what's interesting, and this goes to what you were saying, is there an adjustment or not, are the components of this calculation I'm making here. You can actually split this out between the ratio of prices and the nominal exchange rate. And you can see that it is the case in Brazil that as the real was depreciating, okay, and this is number of dollars per local currency, you can see this depreciation has led to a relative price increase in Brazil. But interestingly, that particularly accelerated here after COVID, but that has not been enough to compensate for the cost of basket and take us back to the previous level. So kind of the point I was making here, if I can zoom out, I don't know how I zoomed in, to be honest, but the part of the thing that we're seeing here is that there's still pressure. If you're interested, for example, in exchange rate pass-through in Brazil today, you can look at these highly tradable goods, compare their prices to the US, and get a sense of whether there's still pressure for us to see prices increasing to compensate for this exchange rate. And the answer for Brazil today is yes. And in fact, in Brazil, if you look at our indices, they are having a lot more inflation even than the CPI. And I think this is partly what is happening. But it's not a global phenomenon yet, at least because many currencies have bounced back. We're not seeing much of this yet.
Very good. I think we went way over time, and I thank you for that. And it was very fascinating and interesting. And I hope you keep on going and improving the index and predictability and guide policymakers with this type of work. I think it's very path-breaking figuring this out.
Thank you so much.
And hope to see you soon in the real world.
Yeah, thank you.
Not only online, like your prizes.